So I'm going to talk about the Where to Live project, and I'm going to particularly talk about the apartment alternative. So if we look at the apartment alternative, we need to look at some detail associated with yourself that actually applies to all the different alternatives. And the first thing you need to know is that you're going to be making $80,000 a year, and you can expect a 5% raise in salaries for the first 15 years with the company. And then you are considering these three options. So the first option, the one we're going to be talking about right now, is the apartment, and it says that you'll rent it for $1,600 a month, and you have a deposit that you have to put down, $2,600, but you're going to get it back when you move out. And you also can expect a 4% every year increase in your salary, and then renter's insurance is going to cost $10 per month. So the other piece of information you need in order to do this is that your tax rate is 28%. So we're going to go ahead and put this together in the spreadsheet. So what I've done here is I have this spreadsheet set up for the apartment. So actually I have this spreadsheet set up for the apartment, and I'm going to go ahead and walk through it so you can see what it is that I've done in the spreadsheet itself. So this is when I told you on that last video to set up all of these tabs across the bottom, and then also to put the different column headings in here. So the first column is the index year, and that just means you're going to number 1 to 20. And then I did the calendar year, which is not as important, but just for reference, I started from 2020 and went to 2039, which is 20 years. And then I have this annual income that's $80,000. And then what's going to happen is that each year it's going to increase at 5%. But what I did wrong here is it said it was going to increase 5% for 15 years. That means after that, I don't want it to increase 5%. So I'm making that change right now where it's going to be flat towards the end of the time, these last 5 years. So you have an increase here, and then then it's flat. Now the actual timing is not exactly clear whether it's 14 years or 15 years or 16 years, but I'm just making a decision for that. The rent here is $1,600 times 2. Times 12, and then that increases 4% a year, and that's going to increase for the whole time period. Renter's insurance, it's actually $10 a month, so I'm going to put 10 times 12, and I had 120. I had 1,200 in there before, but it should be 120. So one of the good things you can see here is I actually designed this spreadsheet so that when I make a change here, it recalculates everything, and that's often the best way to do a spreadsheet. If you can put numbers in that are kind of connected throughout the spreadsheet, then when you make a change, it changes other things. So this renter's insurance, it says it's for 5 years, and then it increases by 10%. In the next 5 years, it's an increase 10%, and then increase 10%. This is the deposit, so I have to put $2,600 down, and then I get it back. So whichever way I enter this deposit into my cash flow calculation, they need to be opposite. So this is $2,600, and this is minus $2,600. So BTCF is before tax cash flow. So the way I've done this is I take, to see what you've done, it's a good way in Excel to double click on that cell, and it'll show you. I took this value, which is your income, minus your rent, minus the renter's insurance, minus the deposit. And that's going to be your cash flow in this year. So after you've earned this money and paid these things out, the insurance, the amount of money you have is $58,080. Now, write-offs for taxes, that means that if you're an individual paying taxes, your write-off is $12,000, which means you're not taxed on the first $12,000. So what you can do is you take your income, oh gosh, that's not right. It's not before tax income. It actually needs to be this income minus your write-off. So it's not, you can't deduct all these other things like you can in the other case. You actually have to pay taxes on that amount. And then that means your taxes, your taxable income is this, and your tax rate is 28% of this. So I take this number and I multiply it by 28%. Your after-tax cash flow then is going to be your income minus your rent, minus your renter's insurance, minus your deposit, minus the taxes that you pay. And I think I had that calculation wrong before, so I'm going to go ahead and put it down this way. So if I look at the double count, that double click that, it's annual income minus rent, minus renter's insurance, minus the deposit, minus the taxes I have to pay. So now I have my after-tax cash flow. And actually you can see here what I've done is, because this F21 here is a minus number, when I subtract it, it actually ends up adding to that value. The present worth factor is just this number in where I calculate the present value of a cash flow that occurs one period in the future. And I included an equation here that I'm going to hopefully, double click. So I have 1.08, which is my discount rate, to the minus 1 factor. So that means that is 1 over 1.08, right? Because that's actually the calculation, 1 over 1 plus I to the n value. And that's, I've programmed that into here to calculate this present worth factor. That means then the present worth is just going to be the after-tax cash flow times the present worth factor. And then I add that all up here by doing this sum, and it gives me my answer. So in this calculation, I've already done the present worth of the apartment option is $580,724. Now, when we compare that to the other two options, we'll be able to decide which is better. So I hope that gives you a little bit of a hint about how to go ahead and create this spreadsheet.